It's our week 5 Business 330 introduction video for the week of July 30 through 9. Today's date is Wednesday, July 5th, and we begin our 2-week study of chapters 8 through 12 on capital valuation and capital budgeting, a key part of our course. We're going to look at chapter 8 and 9 this week, concentrating on a couple of problems on page 263 and 296. And those problems are in a spreadsheet in your Blackboard to review. We also will have a update video this Friday to finish up our discussion of chapters 8 and 9. There is no graded work this week. Assignment number 3 grades will be posted Thursday evening. And another key thing is our Road King course assessment paper has been canceled. I thought about it over this July 4th weekend and had a couple of glasses of Diet Coke, and thought about it, and I just thought that it's asking a little bit too much of you to work on the assignments and get prepared for the final examination and have a 5 to 10 page paper to do and an analysis. I'm just going to incorporate the Road King case and the assessment case into your final examination. It'll be part of the questions on the final examination, which is fine by me. And it's a little bit easier on all of you as you begin and prepare for our second half of this course. So in our Blackboard 330 file folder, if you go to course syllabus schedule and information, you'll see now that I have blanked out the course assessment case paper due July 30th, which was to be posted this week, and it is not required. So we have left in our course assignment number 4, which will be posted next week, due July 16th. And then 2 weeks later, we will have a final examination, which will be distributed on July 23rd and due on July 30th. And we'll have a review session for that final to go over key parts of the capital budget analysis, which will be in the final examination as well. Assignment 4 is good practice for that next week. So that's where we stand in class now. So do not worry about the Road King course assessment paper. That is now off the books. Yay, or yay for you. All right, and here we go into week 5 this week, and we're talking about, I've got to update this, that graded post is now gone, so I'll fix that. We're now talking about capital budgets. What capital budgets is, we invest in an asset, a piece of equipment, a building, a market, a product line, something invested in an asset that we own, and what type of revenue and return will that asset be generating? That's what this capital budget analysis is all about. This week, we talk about chapters 8 and 9. Next week, we'll talk about chapters 10 through 12. This week, we're talking about investment return. What is net present value, internal rate of return, profitability index, and years payback? How do we determine the cash flow that's generated off in an asset that we invest in? That's the subject of our work this week. And here is week 5 in-class review spreadsheet, which I'll be showing you in just a minute. That will be your template for this study, and I will post the solutions to this at the end of the week. So let's take a look at our problem in chapter 8 for this week. This is the problem I'll be reviewing to talk about investment return analysis. This will be the problem taken from your textbook. It's on. It's at the end of chapter 8. It's the very first questions, problems 1 through 9, and we'll be doing this right now in our class review lecture. This is interpretation of a series of cash investments and cash flows off that investment. And what is the investment criteria? Is this return enough to warrant the investment, in this case, of $200? And we use 4 key return analysis that are talked about in chapter 8. The net present value method, the internal rate of return method, the profitability index method, and the payback method. These are the four you'll need to know for future work in this class. So let's take a look at problems 1 and 9. It's on page 264, 265 of your textbook. And this is the problem we'll be using to explain these four criteria to determine whether investment is feasible or not. So let's take a look at it. First of all, we have two different investment decisions. We have two choices. One's project A and one is project B. We're going to be spending $200 on that asset. So we're going to keep this pretty simple with the numbers, but this could be hundreds of millions of dollars, but $200. And then it's expected to generate project A over its life of 4 years, $80 a year in cash flow return. So on an investment of $200, this is generating a return of $320 over 4 years. Project B is a little bit shorter. Same investment of $200 into this asset, and it's going to generate $100 a year for 3 years, and that's $300. So $320 versus $300. What is the better investment? Now you might say $320 is better, you're making more money. But also you might say that $300 is better, you're getting it faster. So that's what the analysis is that we're going to be doing, and converting this into a spreadsheet to do this analysis as described in Chapter 8. The key thing to remember is, why did they pick 4 years for Project A and 3 years for Project B? That is considered the depreciable life of this asset investment. And you remember depreciation from our financial statements and depreciation from your study in accounting. Depreciation is the amount of life that expected this asset to last. That depreciable life is determined by Internal Revenue Service, tax tables. So the depreciable life of a project or an asset determines its cash or investment return, depreciable life. So let's take a look at the spreadsheet in that review sheet that I showed you earlier in Blackboard of how to do this problem. Okay, this is Chapter 8's problems 1 through 8 in Chapter 8 we just saw in the textbook. I've set this up in a spreadsheet, and all our work in this regard will be done on spreadsheets. So first of all, I've set up Project A and Project B. There's the $200 investment today in year 0, and the generated income or cash profits for 4 years, for 3 years. So as I indicated in the beginning of today, we have 4 methods to determine the return on these investments. One is in dollars, it's called net present value. One is in a percent, it's called the internal rate of return. One is in a ratio called the profitability index, and one is in years, the payback years. Same numbers, same information, 4 different ways of looking at the return on this investment, in this case of $200. Now let's take a look at this. Couple things you need to know. What is the investment? There it is right there, $200. How long is the return? Project A is 4 years, Project B is 3 years. And how much cash flow is being generated off that investment? $80 a year here, $100 a year here. In Chapter 9, which will be the subject of our Friday or weekend update video, that Chapter 9 is how did you get these $80? How did you get the $100? Chapter 9 is about cash flow, how to determine cash flow. How did they come up with these amounts? That's what Chapter 9 is all about. And this problem in the spreadsheet right here is a problem 914 in Chapter 9, which we'll review this weekend video, of how you go about determining the cash flow. This is huge. This is huge. Every CFO, every financial manager in the world does this numerous times when they have to determine what is an investment feasible to make. Another thing you need to know in this analysis, besides the investment, how many years, and the cash flow, is what is the cost of capital? What is the discount rate? What is the hurdle rate? What is the weighted average cost of capital? All 3 of different names for the same thing. How much is it costing us to get this $200? Well, in this example in the textbook, it's costing us 11% to get this $200. Pretty expensive money. Probably the company's credit rating is not that good, or high inflation times like we're in now, interest rates go up. Whatever, that's what it cost us to get the money, 11%. And that's considered our discount rate. So in the net present value method, what we're going to do is we're going to take this cash flow over 4 years and over 3 years and discount it at the cost of capital, 11%, to get our discounted cash flow. Let's do that in a formula. Formulas, function, financial. We've seen this before. Net present value, NPV. There it is right there. Hit OK. It brings up the argument or the way of doing it. The interest rate is the cost of capital, 11%. And the value is the cash flow being generated over the time span. So in value, I just go back to my numbers and paint, from year 1 to year 4. So I'm taking B5 to B8, and it's including all those 4 years of $80 payments. And then if I hit OK, it tells me that that $320 in today's dollars at 11% is $248.20. So I'm making an investment of $200 today, generating future cash profits or inflows of $320. That $320 discounted at our cost of money is $248.20. Taking away the investment, the net present value amount is $48.20. We're generating a net return present value of positive $48.20. Let's do the same thing for project B. Formula, function, financial, net present value, same cost of capital, 11%. And now the values are from year 1 through year 3, the $100, C5 to C7. There's our $100 payments or inflows. Hit OK, $244.37. So that's the discounted value of this $300 discounted to today at 11%. So we're making a net present value of $44.37. So in terms of real dollars in today's value, project A is our winner. It has a little bit higher net present value. So that's the one we would pick. Now let's take a look at what this return would be in a percent. That's the internal rate of return. Let's clean this up a little bit. Get that out of there. Make it nice and official. There we go. Well, let's take a look at the internal rate of return. Again, formula, function, financial, internal rate of return, IRR. What is the return in a percent of these cash flows versus the investment? Hit OK, and all we have to do here is paint the values. But in this case, using IRR, we include the investment, year 0 through year 4. So I'm including B4 through B8. I'm including negative cash going out and then money coming in. What is that in a percent? 21.86%. So this project A is costing us 11% in money to get the $200, and it's returning 21.86% in real value. Let's take a look at project B. Same procedure, formula, function, financial, internal rate of return. And again, we paint from year 0 to year 3, C4 to C7. And what is that in a percent? 23.38%. Interesting. Why? Because it's telling us that we're getting the money quicker. So the interest rate or the return rate is higher than, even though project A is returning more money, project B has a better percentage return because you're getting the money quicker. Two different ways of looking at an analysis. More money, greater return. The two differences between project A and B. Let's take a look at the profitability index. The profitability index is a ratio, and the ratio is the relationship of the discounted cash flow to the investment. So I just put in the formula equals the discounted cash flow divided by the investment, and I get 1.24 times greater. In other words, the return is 1.24 times greater than the investment. Let's do that the same for project B, and we get 1.22, okay? Makes sense. The discounted cash flow is higher for project A than project B, thus the ratio would be a little bit greater. And then the payback. How long does it take us in real dollars to pay back the $200 in years? After the first year, we've paid back $80. After the second year, we've paid back now $160. At the end of the third year, we've now paid back $240. Okay, so by somewhere between year 2 and 3, we've paid back the $200. All right. So 1, 2, 3 years. So it's a little bit more than 2 years to pay this back, because at the end of 3 years, we've paid it back plus earned an additional $40. So how do we determine that in actual years? Well, $160 at the end of year 2 have been paid back. That leaves $40 to remaining. $40 left to be paid back to the $200. We're earning $80 in year 3, so $40 remaining as a percent of the $80 is 50%. 1, 2.5 years. 2.5 years. Project B is a little simpler. It's taking us exactly 2 years to pay it back, not 2.5 years like project A. So in terms of payback, naturally project B is the more attractive one because we're getting the money quicker in 2 years instead of 2.5 years. 4 different ways. And those 4 different ways are all showing that 2 of the ways favor project A, net present value and profitability index, and 2 of the ways favor project B, internal rate of return and payback. So that leaves quite a dilemma for the company to decide which one they're going to invest in. And a lot of that is determined by the culture of the company. What do they feel comfortable with? Do they want to make more money, or do they want to get their money quicker? Most companies would choose getting the money quicker, because once you get the money quicker, you can reinvest those returns back into other projects and other investments. But it depends on the company. For example, Ford Motor Company uses the profitability index ratio. Ford does. That's their culture. Apple Computer uses payback, how fast we pay it back. Net present value is used by General Motors. And internal rate of return is by General Electric. Every company has their own way of looking at their investments based on the culture and the history of their decision making in the company. It can depend. Some companies look at all 4 and kind of weigh them against each other. So this is a key point, and this is what Chapter 8 is all about, is how to determine, excuse me, I have to sneeze. Beg your pardon. Chapter 8 is all about the 4 methods. They actually talk about 6 in the chapter, but these 4 are the only ones that you need to be familiar with, that you'll use in future classes, and they're the most popular. Is what of an investment, how much is it going to return to us in dollars, percent, ratio, and payback analysis? You need to know these 4 methods. And to do these 4 methods, you got to know the investment, the length of the investment life, how much you're returning, and the cost of capital. Put all those together and you get this information, which you can now make a strategic decision. In chapter 9, in our weekend video, we'll talk about, as I said earlier, how do we get these amounts? Well, these amounts are considered what is called net cash flow. Net cash flow is equal to net income plus or minus working capital plus depreciation and plus salvage value. Remember, net income is made up of revenues minus expenses to get net income. That's an accounting term. And then we add to it or subtract to it working capital, add back in depreciation and salvage value. That's how much the asset's going to be worth at its disposal. Put all those together and we can calculate this. If any of you are looking for some things to do over the next 48 hours or so over the Thanksgiving break, you can go ahead and look at this problem in chapter 9, 914, where it gives you the parameters to determine net cash flow. And you can determine that on your own. I will be going over this and then once we get the net cash flow, we can do the net present value and all this other calculations like we did right here. But you got to get this cash flow in order to do that. And that's what the problem is all about. The cost of capital in this problem is 12%. That's what we'll be doing in our weekend video. Assignment number 3 will be doing. Okay, so that's the first part of our week work. We're going to look at chapter 9 in our weekend video. Again, if you go to your Blackboard in week 5, under our file folder for this week, Capital Projects 1, in the class lecture review problems, there is the spreadsheet that I just worked on in the video, and there's the solutions to that answers in the video. So if you want to go ahead and try to do those on your own, here's another file with the solutions and also the blank chapter 9 file tab, which we'll look at in our weekend video. So we're beginning the process of determining investment return. Then we're going to look at how we measure the cash flow, and that'll lead into cost of capital and risk analysis as we head into next week in our 2-week capital budgeting review for Business 330. So that's what we have for this week, and I'll see you all in our weekend video this weekend. Also, I will post assignment 3 grades coming up on Thursday evening. Have a great week, everybody, and we'll see you later. Bye-bye.